Something just changed. The bleeding stopped. The panic that has been gripping the silver market for the last 3 days just hit a wall. And now, in the span of a few hours, we are witnessing one of the most violent reversals in the history of commodity trading. Silver is rebounding. Hard. As I am recording this, silver is trading near $88 per ounce. Let that number sink in for a moment. Yesterday, at this exact same time, silver was at $74. That is a gain of $14 in less than 24 hours. That is a move of 18% in one day. This is not a normal bounce. This is not a dead cat. This is a V-shaped recovery that is catching every single bear by surprise. The miners are exploding. The ETFs are vertical. And the crowd that sold at the bottom yesterday is now watching in horror as the price runs away from them. We need to understand what is happening right now because this move is telling us something critical about the psychology of this market. Is this the actual bottom? Or is this just another trap designed to lure in the last wave of buyers before the next leg down? Let me take you back to where we were just 48 hours ago. On Monday morning, silver opened at $78. It had already crashed 31% on Friday after the Warsh announcement. The crowd was in full panic mode. Margin calls were still being triggered. Leverage was still being liquidated, and the selling just would not stop. By Monday afternoon, silver had fallen to $74. That was a total collapse of $48 from the Thursday high of $122. A loss of 39% in 3 days. It was the worst crash since 1980. It was generational capitulation. The forums were filled with despair. Retail traders were posting screenshots of their blown-up accounts. The talking heads on television were declaring the bull market dead. JPMorgan analysts were predicting $50 silver. The narrative was clear. It is over. The bubble popped. Get out while you still can. But then something happened. Something that the bears did not expect. The buyers showed up. Not the weak hands, not the retail crowd, the real buyers, the institutions, the funds, the people who understand that when an asset crashes 40% in 3 days, you do not panic. You accumulate. Monday night, as Asia opened, silver stopped falling. It held 74. It did not break lower. It did not test 70. It just sat there, flat, consolidating. And then, as London opened on Tuesday morning, the bids started coming in, small at first, $1 here, $2 there. But then the momentum shifted. The algorithms detected the change. The short sellers who had piled on during the crash suddenly realized they were exposed, and the squeeze began. By the time New York opened, silver was at $80, then 82, then 85. And now, as I speak, we are sitting near 88. The rebound is not just happening in silver, it is happening across the entire precious metals complex. Gold is up over 5% today. It climbed from 4,600 back to 4,900. Platinum is surging. The mining stocks are on fire. Look at the names. Endeavour Silver is up 7.5% in pre-market. Coeur Mining is up 7.7%. Hecla Mining is up 8%. First Majestic Silver is up 8%. These are the same stocks that lost 17% on Friday. The same stocks that everyone declared dead, and now they are ripping higher. The ETFs tell the same story. ProShares Ultra Silver, the leveraged silver fund that collapsed 62% on Friday, is up 15% today. 15%. The iShares Silver Trust, SLV, is up 8.3%. The ABRDN Physical Silver Shares ETF is up 8.3%. This is not a small bounce. This is a violent snapback. This is what happens when a market becomes oversold to an extreme degree, when everyone who wanted to sell has already sold, when the leverage has been flushed out, when the weak hands have capitulated. That is when the real move begins. But here is the question that everyone is asking right now. Is this the bottom? Is this the V-shaped recovery that marks the end of the correction and the start of the next leg up? Or is this just a temporary relief rally before the market rolls over again and tests lower levels? Let me give you both sides of the argument because this is not a simple question. There are smart people on both sides, and the answer will determine whether you make a fortune or lose everything over the next few weeks. The bull case is simple. The correction was necessary. Silver went parabolic from 30 to 122 in under a year, 400%, driven by momentum and leverage. It needed to reset. The crash flushed out weak hands, cleared excess positioning. Reset sentiment. Now at 88, the market is back to sustainable levels, fundamentals unchanged, structural supply deficit still real, mines not producing enough, solar panels still need silver, EVs still need silver, central banks still buying gold at records, government debt still exploding, debasement trade thesis still valid. Only sentiment changed, and sentiment is temporary. It swings from greed to fear and back. We just saw the fear. Now we see the reversal. Analyst commentary supports this. Multiple strategists say the rout was an exaggerated reaction to short-term catalysts. Investors are reassessing whether the crash signaled a structural breakdown or just positioning reset. The phrase is positioning reset. The market got too crowded, corrected violently, now ready to move higher. The speed of the rebound supports this. If fundamentals had changed, the market would grind lower, chop sideways for weeks, test lows multiple times. Instead, classic V-shaped recovery. That happens when selling was forced liquidation, not fundamental deterioration. The bear case is different. This is a dead cat bounce. Market relieving extreme oversold conditions before rolling over and testing lower. Warsh is still Fed chair nominee, dollar still strong, inflation narrative still under pressure. Nothing changed. Bears argue the rally to 122 was built on sand, driven by Chinese speculators, momentum chasers, retail investors who bought at the top. When that crowd panics, the crash is just beginning. JPMorgan's Kolanovic still calls for $50 silver. If he is right, 88 is not the bottom. It is a pause on the way down. History shows past blow-off tops always see initial bounces get sold. Market rallies 10 or 20%, people get excited, think bottom is in, then market rolls over and makes new lows. Psychological trap designed to catch optimists. So which side is right? I do not know. Nobody knows. But I can tell you what probabilities suggest. Probabilities favor the bull case. The selling was too climactic. Fear too extreme. Liquidation too violent. When a market crashes 40% in 3 days, it is not because fundamentals changed. It is because positioning was extreme and leverage too high. When that happens, rebound is usually sharp and sustainable. Smart money knows this. That is why mining stocks are up 8%. That is why ETFs are surging. Institutions see the supply deficit, industrial demand, debasement trade. When an asset with strong fundamentals crashes 40% on sentiment shift, you buy it. But here's the key. The smart money is not buying because they think silver is going back to 122 next week. They are buying because they think 88 is closer to fair value than 74. They are buying because they think the correction is over and the next leg up will happen over the next 6 to 12 months. They are playing the long game. The retail crowd, on the other hand, is playing the short game. They are looking at the chart and asking, will it go up tomorrow? Will it go up next week? And that is the wrong question. The right question is, will silver be higher in 6 months than it is today? And the answer to that question is almost certainly yes, because the fundamentals have not changed. Because the supply deficit is real. Because the industrial demand is accelerating. Because the central banks are still buying. Because government debt is still exploding. The correction was necessary. But the trend is intact. Now let me tell you about the catalyst nobody is talking about. The Trump-India trade deal. Monday, Trump announced trade agreement with India. Cut tariffs on Indian goods from 50% to 18%, effective immediately. This is massive. India is second largest gold and silver consumer. 1.4 billion people. When tariffs drop from 50 to 18%, it changes precious metals economics, makes it cheaper for India to import, easier for buyers to access market, signals trade tensions easing. Market reacted immediately. Spot gold jumped 4% Monday. Spot silver surged 11% Monday and Tuesday. Platinum rallied 3%. Entire commodity complex went vertical. India is not just consumer. India is signal. When US and India make deal, global trade war is de-escalating. Trump willing to negotiate. Worst case scenario, full-blown trade collapse is off the table. When that fear is removed, commodities rally. Indian market exploded. MCX gold surged 6%. MCX silver rallied 13 to 15%. Indian mining stocks went vertical. Sentiment shifted from panic to optimism in hours. AJ Kedia, commodity expert in India, said gold and silver attempting recovery following historic blood moon sell-off. Called Trump-Modi deal double-edged sword for precious metals. Tariff relief is bullish, makes it cheaper for India to buy. But deal removes key geopolitical risk, driving safe haven demand. On balance, market treating it as bullish. Prices are rising. So here is where we stand. Silver crashed from 122 to 74, a loss of 39% in 3 days. It was the worst crash since 1980. The crowd panicked, the weak hands sold, the leveraged positions were liquidated, and then just as everyone declared the bull market dead, the market reversed. Silver bounced from 74 to 88, a gain of 18% in 1 day. The mining stocks are up 8%. The ETFs are up 15%. The sentiment has shifted from extreme fear to cautious optimism. The question now is what happens next. Do we consolidate here? Do we chop sideways for a few days while the market digests the move? Or do we rip higher and test 90, 100, 110? The answer depends on the follow-through. If the buyers keep showing up, if the bids keep coming in, if the momentum continues, then this is the bottom. This is the start of the next leg up. But if the market stalls here, if we see profit taking, if the sellers come back, then this might just be a relief rally. We might retest 74. We might go lower. The key level to watch is 85. If silver holds above 85, if it refuses to give back the gains, then the bulls are in control. But if we break back below 80, if we lose the momentum, then the bears will regain confidence and the selling could resume. So what should you do? If you sold at the bottom, if you panic sold at 74 or 78, this is painful. You are watching price run away. You are kicking yourself, but do not chase. Do not FOMO back in at 88. Wait for a pullback. Wait for consolidation. Wait for lower risk entry. If you held through the crash, congratulations. You passed the test. You survived the shakeout. Now decide whether to add or hold. My suggestion is wait. Let market prove itself. Let it hold these gains for days. Then if it consolidates and shows strength, consider adding on pullback. If you're in cash, waiting on sidelines, this is interesting. Market crashed 40% and bounced 18. Extreme volatility, dangerous, but also opportunity. Smart play is scale in slowly. Buy small position here. If it goes lower, buy more. If it goes higher, you have exposure. Do not go all in. Do not bet the farm. This market is still violent, still unpredictable, but trend is still up. Fundamentals still intact. The correction was brutal. But the bull market is not over. This is the shakeout. This is the reset. This is the moment when the weak hands are separated from the strong hands. And if you are still here, if you're still holding, if you are still watching, then you are one of the strong hands. The market just tested you, and you passed. Now the question is what you do with that advantage. Do you hold and wait? Do you add on weakness? Do you take profits on strength? The answer depends on your time horizon. If you are trading, if you're trying to catch the swings, then this is a dangerous game. The volatility is extreme. The moves are unpredictable. You could get chopped up. But if you are investing, if you are playing the long game, if you believe in the supply deficit and the debasement trade and the industrial demand, then this crash was a gift. It gave you a chance to buy at 74. And if you missed it, it might give you another chance if we pull back to 80. The key is to not let the noise distract you from the signal. The noise is the daily volatility, the crashes and the rebounds, the panic and the euphoria. The signal is the trend. And the trend is still up. Silver is still up over 100% from where it was a year ago, even after the crash, even after losing $48 in 3 days. It is still one of the best performing assets in the world. And the reasons why it went up in the first place have not changed. The mines are still not producing enough. The industrial demand is still accelerating. The central banks are still buying gold. The governments are still printing money. The debasement trade is still valid. The correction was necessary, but the thesis is intact. So do not let the crash scare you. Do not let the volatility shake you out. Do not let the bears convince you that the bull market is over, because it is not over. It is just getting started. This is the shakeout. This is the test. This is the moment when fortunes are made and lost. And the people who win are the ones who have the courage to buy when everyone else is selling. The people who win are the ones who understand that volatility is not risk. Volatility is opportunity. The people who win are the ones who hold through the fear and accumulate on the dips. Silver just crashed 39% and bounced 18% in 4 days. That is insane. That is unprecedented. That is the kind of move that only happens once or twice in a generation. And you are watching it happen in real time, so pay attention, stay disciplined, do not panic, do not chase. Most importantly, do not let the market shake you out of a winning position. Because in 6 months, when silver is back above 100, you will look back at this moment and realize that $74 was the opportunity of a lifetime. And the only question that will matter is whether you had the courage to take it.